Let me tell you something that most investors completely misunderstand about the semiconductor industry. Everyone is focused on the chip makers. They are buying shares of companies that design processors and memory and graphics cards. But they are missing the real opportunity. The companies that make the equipment used to manufacture those chips. These are the businesses that will generate extraordinary returns over the next few years. And I am going to share exactly which 3 equipment stocks are positioned to surge in 2027. I have spent over 30 years building a semiconductor company from nothing into one of the most valuable businesses on the planet. I have watched this industry evolve through multiple generations of technology. I have seen companies rise and fall. I have seen fortunes made by investors who understood where the real value creation was happening. And right now, in 2026, the real value creation is happening in chip manufacturing equipment. Here is why this moment is so important. The world is entering an unprecedented period of semiconductor manufacturing expansion. Governments around the globe are subsidizing new fabrication plants. Artificial intelligence is driving demand for advanced chips beyond anything we have seen before, and the equipment makers are the bottleneck. Every new fab, every capacity expansion, every technology upgrade requires their machines. Without the equipment, none of this happens. Today, I am going to explain exactly why chip equipment stocks are positioned for explosive growth in 2027. I am going to share the 3 specific companies that dominate this space and why their competitive positions are essentially unassailable. And I am going to show you why now is the time to invest before the market fully recognizes what is coming. Let me take you back to 1993. I had just founded my company with 2 partners. We had no revenue, no products, and an idea that most people thought was crazy. We believed that graphics processing would become essential to computing. The semiconductor industry at that time was dominated by a few large players who controlled both design and manufacturing. What I learned during those early years shaped everything I understand about this industry today. I learned that the companies providing the tools, the equipment, the essential infrastructure, they often have better businesses than the companies using those tools. Pick and shovel investing, they call it. During a gold rush, the people selling picks and shovels often make more reliable money than the miners. The semiconductor equipment industry is the ultimate pick and shovel business. When chip makers need to expand capacity, they buy equipment. When they need to advance to smaller process nodes, they buy new equipment. When governments subsidize new fabs, that money flows to equipment purchases. The equipment makers win regardless of which chip company succeeds, because all of them need the same machines. I watched this dynamic play out through multiple industry cycles. In the late 1990s, the equipment makers surged as companies built capacity for the personal computer boom. In the 2000s, they surged again as mobile devices drove demand. In the 2010s, they benefited from cloud computing build-out. And now, in the 2020s, artificial intelligence is driving the biggest expansion cycle in industry history. The framework for understanding chip equipment investing comes down to 3 factors. First, you need to understand the capital intensity of semiconductor manufacturing. Building a modern fabrication plant costs $20 to $30 billion. A significant portion of that spending goes to equipment. When Intel announces a new fab, when TSMC expands capacity, when Samsung upgrades their facilities, the equipment makers receive billions in orders. Second, you need to understand the technology moats in this industry. Manufacturing advanced semiconductors requires equipment so sophisticated that only a handful of companies in the world can produce it. These are not commodities that can be easily replicated. The barriers to entry are measured in decades of research and development, thousands of patents, and billions in accumulated know-how. New competitors cannot simply enter this market. Third, you need to understand the current supply-demand dynamics. Right now, there is a global race to build semiconductor manufacturing capacity. The United States is investing over $50 billion through the CHIPS Act. Europe is investing similarly through their own programs. Japan, South Korea, Taiwan, China, everyone is building fabs. This creates a multi-year demand surge for equipment that the market has not fully priced in. With this framework in mind, let me share the 3 chip equipment stocks that are positioned to surge in 2027. The first stock is ASML Holding, the Dutch company that holds an absolute monopoly on the most advanced lithography equipment in the world. If you only buy one chip equipment stock, this should be it. There is simply no alternative to what ASML provides. Let me explain what lithography does, because understanding this is essential. Semiconductors are manufactured by projecting patterns onto silicon wafers using light. The smaller you can make those patterns, the more transistors you can fit on a chip, the more powerful and efficient the chip becomes. Lithography equipment projects those patterns with incredible precision. ASML's extreme ultraviolet lithography machines, called EUV machines, are the only equipment capable of manufacturing the most advanced chips. Every smartphone processor, every high-performance AI chip, every cutting-edge semiconductor requires EUV lithography. And ASML is the only company in the world that makes these machines. I want you to understand how extraordinary this monopoly is. An EUV machine costs approximately $350 million. It weighs over 100 tons. It requires multiple specialized planes to transport. It uses light sources that push the boundaries of physics. No other company on Earth can build one. China has been trying for years and cannot replicate it. Intel tried to develop their own lithography decades ago and failed. ASML has spent over 20 years and invested tens of billions of dollars developing this technology. The demand for EUV machines is exploding. TSMC needs them for their 3 nanometer and 2 nanometer process nodes. Intel needs them for their foundry ambitions. Samsung needs them to stay competitive. Every advanced fab being built or upgraded requires EUV lithography. ASML has a backlog extending years into the future because they cannot build the machines fast enough. But here is what makes the 2027 opportunity so compelling. ASML is introducing their next generation machine called High-NA EUV. This machine enables even smaller features and will be required for the most advanced chips in 2027 and beyond. The High-NA machines cost over $500 million each. The upgrade cycle will drive massive revenue growth. ASML also generates substantial recurring revenue from service and parts. Once a fab installs an EUV machine, they need ongoing support, maintenance, and upgrades. This recurring revenue stream provides stability and grows as the installed base expands. The stock has performed well but is not fully pricing in the magnitude of the upcoming cycle. The combination of new fab construction globally, the High-NA upgrade cycle, and the insatiable demand for AI chips will drive ASML's revenue and earnings significantly higher through 2027. This is a company with an impregnable competitive moat and a multi-year growth runway. The second stock is Applied Materials, the largest semiconductor equipment company by revenue and the most diversified player in the space. If ASML is the specialist, Applied Materials is the generalist that provides equipment for nearly every step of the chip manufacturing process. Let me explain why diversification matters in this industry. Manufacturing a modern semiconductor involves hundreds of process steps: deposition, etching, ion implantation, inspection, packaging. Each step requires specialized equipment. Applied Materials provides tools for most of these steps, making them an essential partner for every major chip maker. I have worked with Applied Materials throughout my career. When we develop a new chip architecture, we work closely with equipment makers to ensure the manufacturing process can deliver the performance we need. Applied Materials has the broadest portfolio of any equipment company, which means they are involved in nearly every advanced chip development program. The company's position in deposition and etching equipment is particularly strong. Deposition involves adding thin layers of materials to a wafer. Etching involves removing materials to create patterns. Both processes become more complex and critical as chip features shrink. Applied Materials has invested heavily in developing solutions for the most challenging manufacturing steps. Zone area where Applied Materials is seeing explosive growth is in advanced packaging. This is a trend that many investors do not fully appreciate, as it becomes harder to shrink transistors further. Chip makers are increasingly connecting multiple chips together in advanced packages to improve performance. This approach requires entirely new manufacturing equipment, and Applied Materials is a leader in this space. The demand from AI is particularly relevant for Applied Materials. Training and running AI models requires massive amounts of memory and processing power. High bandwidth memory, which connects to AI processors, is manufactured using advanced packaging techniques that Applied Materials equipment enables. Every AI data center being built today requires chips made with Applied Materials tools. The geographic diversification of semiconductor manufacturing also benefits Applied Materials. They sell equipment to customers in Taiwan, Korea, the United States, China, Japan, and Europe. As each region builds out domestic manufacturing capacity, Applied Materials receives orders. The CHIPS Act funding is just beginning to flow into actual equipment purchases. The European CHIPS Act is ramping. This creates a multi-year tailwind. Applied Materials also has a growing service business that provides recurring revenue as the installed base of equipment expands. Service revenue grows. The company is increasingly attaching software and data analytics services to their equipment, creating additional revenue streams with high margins. The stock trades at a reasonable valuation relative to its growth prospects. The combination of advanced packaging growth, AI demand, global fab expansion, and service revenue growth should drive earnings significantly higher through 2027. This is a company with leading positions across multiple equipment categories, benefiting from every major trend in semiconductors. The third stock is Lam Research, which dominates the critical processes of etching and deposition that become more important as chips become more complex. Lam is less diversified than Applied Materials, but has stronger positions in their focused areas. Let me explain why etching and deposition are so critical. Modern chips have features measured in nanometers, billionths of a meter. Creating these tiny features requires removing and adding materials with atomic-level precision. A single error can ruin an entire wafer worth potentially millions of dollars. Lam Research's equipment provides that precision. The shift to three-dimensional chip architectures has been particularly beneficial for Lam. Traditional chips were essentially flat, with features arranged in a single plane. Modern memory chips and increasingly logic chips stack features vertically to increase density. Building these three-dimensional structures requires many more etching and deposition steps, dramatically increasing the amount of Lam equipment needed per wafer. The memory market is especially important for Lam memory chips. Both DRAM and NAND flash use more etching and deposition steps per wafer than logic chips. As memory capacity increases, as AI drives demand for more memory, as new memory technologies emerge, Lam benefits disproportionately. The company has the largest market share in memory equipment. AI is creating unprecedented demand for high bandwidth memory. These memory chips sit adjacent to AI processors and provide the data bandwidth needed for training and inference. Manufacturing high bandwidth memory requires advanced etching and deposition processes that are Lam's specialty. Every major memory maker is expanding capacity to meet AI demand, and Lam equipment is essential to those expansions. Lam also has a strong position in the foundry market. TSMC, the largest contract chip manufacturer in the world, is a major Lam customer. As TSMC builds new fabs in Arizona, Japan, and Germany to serve their global customers, they need Lam equipment for each facility. The geographic expansion of leading-edge manufacturing creates sustained demand. The company has been gaining market share in several important process steps. Their atomic layer etching technology is becoming essential for the most advanced nodes. Their selective deposition tools enable new transistor architectures. These technology leadership positions translate into share gains that amplify overall market growth. Lam generates substantial recurring revenue from spare parts and service. The installed base of Lam equipment is enormous, and each tool requires ongoing consumables and maintenance. This recurring revenue provides stability and grows as new equipment is installed. The stock has underperformed peers recently due to cyclical concerns in the memory market, but this creates opportunity. Memory demand is recovering, driven by AI. The new manufacturing cycle is beginning. Lam's leadership in the processes most critical to advanced manufacturing positions them for significant growth through 2027. Now let me synthesize why these three stocks together represent the optimal way to invest in the chip equipment theme. ASML provides exposure to the most advanced lithography technology with an absolute monopoly position. They benefit most from the push to leading-edge manufacturing nodes and will capture enormous value from the high-NA upgrade cycle. Applied Materials provides the broadest exposure to semiconductor equipment with diversification across process steps, customer types, and geographies. They benefit from every major trend, including AI, advanced packaging, and global fab construction. Lam Research provides focused exposure to the etching and deposition processes that become more intensive as chips become more complex. They benefit particularly from memory expansion and three-dimensional architectures together. These three companies account for the vast majority of critical semiconductor manufacturing equipment. Owning all three provides diversified exposure to the equipment theme while concentrating in the companies with the strongest competitive positions. The timing for this investment is particularly favorable. We are early in a multi-year capital spending cycle driven by AI demand and government subsidies. The CHIPS Act funding is just beginning to convert into actual equipment orders. The memory cycle is recovering. New fabs announced in 2023 and 2024 are placing equipment orders now for production in 2026 and 2027. The market tends to underestimate the duration and magnitude of semiconductor capital cycles. Analysts see a good year and assume the cycle is peaking. In reality, the structural drivers of this cycle, AI adoption, geographic diversification, technology complexity, suggest it will continue for several more years. The equipment makers will compound earnings growth through 2027 and likely beyond. Let me address some common concerns about investing in chip equipment stocks. Some investors worry about cyclicality. It is true that semiconductor equipment spending fluctuates with industry cycles. There are boom years and slower years. But the structural trend is clearly higher. Each cycle peaks at a higher level than the last. And the current cycle has drivers, AI and geopolitics, that suggest unusual magnitude and duration. Some investors worry about China restrictions. The United States has restricted sales of the most advanced equipment to Chinese customers. This does reduce the addressable market somewhat, but the impact is smaller than headlines suggest. China was not buying significant quantities of EUV equipment anyway because they lacked the expertise to use it effectively. And Chinese customers are still buying older generation equipment for mature manufacturing processes. Some investors worry about valuation. Chip equipment stocks have performed well and trade at premium multiples to the broader market. But those multiples are justified by the growth rates and the quality of the businesses. These are companies with wide moats, high returns on capital, and multi-year growth runways. Paying a premium multiple for that combination makes sense. Some investors worry about concentration. ASML, Applied Materials, and Lam together dominate the equipment industry. Could antitrust regulators intervene? It is possible, but unlikely. These are not consumer-facing companies engaging in anti-competitive behavior. Their dominance reflects decades of investment and technological leadership. Regulators have shown no appetite for breaking up specialty industrial companies. For investors looking to build positions in these stocks, I would suggest a dollar-cost averaging approach. Invest a fixed amount monthly, regardless of price. This reduces the risk of buying at a temporary peak and ensures you build a position over time. The long-term trajectory is clearly higher, but short-term volatility is inevitable. Position sizing should reflect your overall portfolio strategy. For most investors, an allocation of 5 to 10% of their equity portfolio to semiconductor equipment makes sense. This provides meaningful exposure to a high-growth sector without excessive concentration. Consider holding these stocks in tax-advantaged accounts if possible. The growth potential suggests significant capital gains over time. Holding in an IRA or similar account allows those gains to compound without annual tax drag. Do not try to time the cycle. Investors who wait for the perfect entry point often miss the majority of the gains. The best time to invest is when the fundamental drivers are in place, which they clearly are today. The second best time is any time before those drivers fully play out. The semiconductor industry is experiencing a once-in-a-generation transformation driven by artificial intelligence. Every major technology company is investing heavily in AI infrastructure. That infrastructure requires advanced semiconductors. Those semiconductors require manufacturing equipment. The equipment makers are the essential enablers of this transformation. ASML, Applied Materials, and Lam Research are not just beneficiaries of this transformation. They are the gatekeepers. Without their equipment, the AI revolution cannot proceed. Without their machines, the new fabs cannot produce chips. Without their technology, Moore's law cannot continue. Their positions are unassailable and their growth is assured. 2027 will be a watershed year for these companies. The fabs being built today will be reaching full production. The high-NA lithography transition will be accelerating. AI chip demand will be even higher than today. Memory capacity will be expanding rapidly. Every major trend in semiconductors flows through the equipment makers. I have spent my career building one of the most successful chip companies in history. I understand this industry deeply, and I am telling you that the opportunity in chip equipment stocks is exceptional. These are not speculative bets on unproven technologies. These are investments in dominant companies with decades-long track records, essential products, and clear growth drivers. The market has begun to recognize this opportunity, which is why these stocks have performed well, but the magnitude of the cycle ahead is not fully appreciated. The duration of the growth is not fully priced in. The compounding effect of recurring service revenue is underestimated. There is still significant upside from current levels. If you want to participate in the AI revolution, if you want exposure to the most important technology trend of our time, chip equipment stocks are the way to do it. You do not have to pick which AI company will win. You do not have to predict which chip architecture will dominate. You just have to own the companies that provide the essential equipment that everyone needs: ASML, Applied Materials, and Lam Research. These three companies control the manufacturing technology that makes modern semiconductors possible. They will continue to dominate for decades to come, and their stocks will reward patient investors who understand the magnitude of the opportunity ahead. The chip equipment surge of 2027 is not speculation. It is the logical consequence of investment decisions already made and trends already in motion. The only question is whether you will be positioned to benefit when it arrives. Let me go deeper on the specific catalysts that will drive each of these stocks higher over the next 18 months, because understanding the timing helps you build conviction to hold through volatility. For ASML, the primary catalyst is the high-NA UV ramp. The first high-NA machines shipped in 2024 and 2025 to leading customers for development and qualification. By 2027, volume production using high-NA will begin at multiple customers. Each machine generates over $500 million in revenue. ASML expects to ship dozens of these systems over the next several years. This is a massive revenue driver that the current stock price does not fully reflect. The capacity expansion at ASML itself is another catalyst. The company has been investing heavily in their manufacturing facilities to meet the exploding demand. they have committed to doubling their production capacity for EUV systems. As this capacity comes online, revenue growth will accelerate. The constraint has been ASML's ability to produce enough machines, not customer demand. The China situation, while creating headlines, actually benefits ASML in some ways. Chinese customers who cannot buy EUV are instead buying the maximum number of older DUV lithography systems they can acquire. This drives strong demand for ASML's mature product lines, while the advanced EUV and high-NA products drive growth from leading-edge customers. The company wins regardless of geopolitical outcomes. For Applied Materials, the catalyst is the advanced packaging boom. The company held an extensive investor event specifically focused on this opportunity. Advanced packaging revenue has been growing over 30% annually, and that growth is accelerating. Every major AI chip uses advanced packaging. Every high-bandwidth memory stack uses advanced packaging. This market barely existed 5 years ago and is becoming one of the largest opportunities in semiconductor equipment. The gate all-around transistor transition is another catalyst for Applied Materials. This new transistor architecture is being adopted at the 2-nanometer node, and below it requires new deposition and etching processes, where Applied Materials has leading positions. The transition creates a tool intensity increase that drives more equipment spending per wafer. The ICAP segment at Applied Materials, which stands for IoT communications, automotive, power, and sensors, is growing rapidly. These are chips manufactured on mature nodes for applications beyond smartphones and PCs. Electric vehicles, industrial automation, and infrastructure all require these chips. Applied Materials has specifically invested in tools optimized for these applications, creating a growth driver independent of leading-edge manufacturing. For Lam Research, the memory recovery is the primary catalyst. Memory spending was depressed in 2023 and early 2024. As customers work through excess inventory, that inventory correction is complete. Memory demand is recovering strongly, driven by AI servers that require massive amounts of high-bandwidth memory. Lam has the highest exposure to memory among the large equipment companies, so they benefit disproportionately from this recovery. The NAND flash transition to higher layer counts is another Lam catalyst. Modern NAND flash memory stacks over 200 layers of storage cells vertically. Each layer requires deposition and etching steps. As layer counts increase toward 300 and eventually 400 layers, the number of process steps per wafer increases dramatically. Lam's equipment intensity per bit of memory produced keeps rising. Lam's cryogenic etching technology is gaining adoption for the most challenging applications. This technology uses extremely cold temperatures to achieve better process control and enable features that were previously impossible. It is becoming essential for advanced memory and logic manufacturing. The technology differentiation supports pricing power and market share gains. Let me also explain the service revenue opportunity in more detail, because this is consistently underappreciated by investors. All three companies have large installed bases of equipment at customer fabs. These tools require spare parts, consumables, maintenance, and upgrades throughout their operating lives. Service contracts typically generate 15 to 20% of initial equipment price annually. As the installed base grows with each equipment cycle, service revenue compounds. The service business has several attractive characteristics. It is recurring and predictable. Customers cannot operate their fabs without maintaining their equipment. The margins are typically higher than equipment sales because spare parts and labor carry strong profitability. And the service relationship creates switching costs that make customers reluctant to change equipment vendors. ASML's service revenue has been growing over 15% annually as their EUV installed base expands. Applied Materials and Lam have similar dynamics. By 2027, service revenue at these companies will be substantially higher than today, providing a stable foundation even if equipment sales fluctuate. Software and data analytics are becoming additional revenue streams. Modern fabs generate enormous amounts of data from their equipment. The equipment makers are developing software tools to analyze this data, optimize processes, and predict maintenance needs. Customers pay subscriptions for these tools, creating another layer of recurring revenue. Let me discuss the competitive dynamics that protect these companies' market positions, because durability of returns is essential for long-term investing. The semiconductor equipment industry has extremely high barriers to entry. Developing competitive equipment requires billions of dollars in R&D spending over many years. It requires deep relationships with leading chip makers who collaborate on next-generation processes. It requires manufacturing expertise that takes decades to develop. New entrants simply cannot catch up. The technology requirements keep increasing. Each new chip generation requires more precise, more complex manufacturing processes. This benefits the incumbent equipment makers who have the expertise and resources to develop ever more sophisticated tools. The gap between leaders and followers widens over time rather than narrowing. Customer relationships in this industry are deeply collaborative. Equipment makers work closely with chip manufacturers years before new products launch. They co-develop processes, optimize tools for specific applications, and provide ongoing support. These relationships create switching costs. A chip maker who has qualified their process on one vendor's equipment faces enormous time and cost to switch to an alternative. The industry structure has been remarkably stable. ASML, Applied Materials, Lam Research, and a few other companies have dominated equipment for decades. M&A occasionally shifts market share, but new entrants almost never succeed. This stability suggests the current leaders will remain leaders through 2027 and far beyond. Let me address how to think about valuation for these stocks, because paying the right price matters even for great companies. Traditional valuation metrics, like price-to-earnings ratios, are somewhat misleading for cyclical companies. Earnings fluctuate with the equipment cycle, making point-in-time multiples difficult to interpret. A stock might look expensive at a cycle peak when earnings are elevated, or cheap at a cycle trough when earnings are depressed. I prefer to look at normalized earnings power. What can these companies earn through a full cycle? What is the trend line of earnings growth on that basis? All three companies are reasonably valued relative to their growth prospects. They trade at premiums to the market, but those premiums are justified by superior growth rates and returns on capital-free cash flow generation. Is another important metric. All three companies generate substantial free cash flow that they return to shareholders through dividends and buybacks. ASML has a particularly aggressive capital return program. These cash returns provide downside protection and enhance total returns over time. The enterprise value to sales ratio is useful for comparing equipment companies. Sales are less volatile than earnings and provide a cleaner view of relative valuation. On this metric, ASML commands a premium reflecting its monopoly position in EUV. Applied Materials and Lam trade at similar valuations, reflecting their comparable market positions. For long-term investors, modest differences in entry valuation matter less than the compounding of business fundamentals over time. All three stocks are reasonably priced for the growth ahead, waiting for a significant pullback risks, missing the upside, and there may not be a significant pullback given the strength of underlying demand. Let me share some thoughts on how these stocks fit into a broader investment portfolio. Semiconductor equipment stocks provide exposure to some of the most important technology trends in the world. AI, cloud computing, electric vehicles, and industrial automation all depend on advanced semiconductors. Owning the equipment makers gives you exposure to all of these trends simultaneously. These stocks tend to be more volatile than the broad market. Equipment spending is cyclical, and stocks can move significantly on order announcements or cycle predictions. Investors need to be prepared for this volatility and avoid selling during temporary downturns. Diversification within the sector makes sense. Owning all three companies provides exposure to different parts of the equipment market. If one company faces temporary challenges, the others may be performing well. The sector allocation performs regardless of which specific company has the best quarter. The equipment stocks have relatively low correlation with other technology stocks. They benefit from chip demand, but their customers are the chip makers, not end consumers. When consumer technology stocks struggle, equipment makers may continue performing well if chip manufacturing investment continues. For investors who want simplified exposure, there are ETFs focused on semiconductor equipment. However, these ETFs often include companies beyond the three leaders I have discussed. For concentrated exposure to the highest quality equipment businesses, direct stock ownership is preferable. The opportunity in chip equipment stocks is not a secret. These companies have performed well and are followed by many analysts. But the market consistently underestimates the magnitude and duration of semiconductor capital cycles. The structural drivers today, AI, geopolitics, and technology complexity, are stronger than in previous cycles. The companies are positioned to exceed expectations. 2027 will be a remarkable year for semiconductor equipment. The investments being made today in new fabs and advanced manufacturing will be producing chips at scale. The high-NA lithography transition will be well underway. Memory demand will have fully recovered and be growing strongly. The equipment makers will be reporting revenue and earnings that surprise the market. I have spent my career at the center of the semiconductor industry. I have watched technological revolutions come and go. I have seen which companies create lasting value and which ones fade away. The equipment makers are the enduring winners in this industry. They provide the essential infrastructure that makes everything else possible. ASML, Applied Materials, and Lam Research are not just good investments for 2027. They are franchises that will compound value for decades. The technology moats are wide and widening. The customer relationships are deep and durable. The growth drivers are strong and accelerating. If you believe that artificial intelligence will transform the economy, if you believe that advanced semiconductors are the foundation of that transformation, if you believe that manufacturing those semiconductors requires sophisticated equipment, then these three stocks deserve a place in your portfolio. They are the picks and shovels of the AI gold rush, and the gold rush is just beginning.